FinTech and the Evolution of Financial Intermediation. All right, let's dive right into this explainer. If you tapped your phone to pay for coffee today, or maybe checked up on an automated investment portfolio, you are actively participating in a massive paradigm shift. But look, this goes way beyond just having a few convenient apps on your home screen. It's a fundamental redefinition of how money moves, how it's stored, and how it grows. The traditional, heavily regulated financial core is being completely challenged and rapidly integrated with these incredibly agile tech firms. So let's explore exactly how we're shifting into this entirely new hybrid financial model.
So, when did financial technology actually begin? There is this super persistent myth out there that fintech was basically born in 2009, right alongside the smartphone. But to really grasp the sheer magnitude of today's disruption, we need to bust that myth wide open. Applying technological innovation to finance, that is absolutely not a new concept, it's actually a multi-generational practice.
See, financial institutions have literally always been eager early adopters. Going all the way back to 1865, the Pantelegraph was used to verify signatures via this crazy early fax system. Fast forward a bit, and by 1918, Fedwire was already transferring funds electronically. Then the 70s brought us the NASDAQ, and the 80s ushered in those massive bank mainframes. The main takeaway here is undeniable. Banks have been leveraging advanced technology for well over a century. And honestly, that sets up a really big mystery for us. If banks have always been tech-savvy, what makes today's revolution so radically different?
Well, the real shift, the true novelty here, isn't the technology itself. It's actually the origin of the innovation. Historically, finance relied on a closed approach. Banks built their own proprietary mainframes and their own highly secured internal networks. But today, it's completely open. For the very first time, the innovation, the raw skills, and the capital are flooding in from entirely outside the regulated banking sector. We've got unregulated entities leveraging digital frameworks to offer solutions that used to be totally locked down by traditional middlemen, and it is shaking the old banking foundations to their absolute core.
Now, the ultimate catalyst for all of this was an explosive, totally unprecedented leap in computing power. Let's put this into perspective. Back in 1969, the Apollo Biden's computer literally took humanity to the moon, running on just 2 megahertz of speed and 4 kilobytes of RAM. Compare that to a standard 2018 smartphone, which operates at 2.1 gigahertz with 4 gigabytes of RAM. That is a mind-boggling upgrade. Putting that kind of massive processing power directly into the pockets of everyday consumers is exactly what allowed external startups to completely bypass the huge, clunky infrastructure of traditional banks.
But raw computing power on its own needed a spark, right? It needed a perfect storm, and that storm hit right around 2008. On the supply side, you had the global financial crisis, which basically shattered consumer trust in traditional banks overnight, while low interest rates severely squeezed bank profits. Then on the demand side, you had a brand new generation of digital native millennials entering the workforce, and they were demanding the exact same seamless, real-time digital experiences they were already getting from apps like Amazon and Uber.
To capture this immense new demand, these outside challengers essentially weaponized a specific digital toolkit. We call it SMACI: Social, Mobile, Analytics, Cloud, and Artificial Intelligence. They leverage social networks for unprecedented reach, mobile tech for direct 24/7 consumer access, and deep analytics to really parse out consumer behavior. Add in cloud computing to completely sidestep those heavy, expensive on-premise servers, and top it off with AI to automate complex financial decisions in milliseconds. These specific digital pillars are exactly what empowered these agile little startups to suddenly threaten massive, established monopolies.
And this sets up just a fascinating core rivalry. It's essentially sheer speed versus massive resources. These unburdened fintech challengers act like cheetahs, right? They're agile, totally consumer-centric, and entirely free from decades of legacy IT debt or the burden of running a sprawling physical branch network. The incumbent banks, on the other hand, are the elephants. Sure, they move a lot slower, but they hold the ultimate trump card, known as the 3 Cs. That's massive existing customer bases, deep expertise in strict regulatory compliance, and incredibly deep pools of capital.
Let's look at how this plays out in the real world, starting with payments and clearing. Fintech has completely decentralized how we transfer value. Instead of logging into some clunky bank interface, we're all using mobile wallets like Apple Pay and peer-to-peer layers like Venmo to route money instantly. And taking it even a step further, cryptocurrencies, like Bitcoin, along with emerging central bank digital currencies, are actively testing fundamentally new frameworks. The goal? Bypassing commercial banking intermediaries entirely and putting decentralized financial intermediation right there on our home screens. Moving over to credit and capital, non-bank models are actively bypassing traditional balance sheets altogether. Think about crowdfunding sites like Kickstarter or lending marketplaces like Lending Club. They connect the people who have the capital directly with the people who want to borrow it. By stripping out all that massive overhead and the strict regulatory burdens of a brick-and-mortar bank network, these digital platforms can effectively arbitrage the difference. The result? Highly competitive rates for the borrowers and much higher yields for the people actually providing the capital. It's a win-win.
We're seeing a similar structural democratization happen in investment management too. Look at high-frequency trading. Algorithmic access used to be something strictly reserved for Wall Street elites, but now it's paved the way for massive retail innovation. Platforms like eToro offer social copy trading, while robo-advisors are out there automating customized portfolios at an unprecedented scale. They are completely commoditizing traditional human wealth management and aggressively driving down industry fees across the board.
Now, you might easily assume regulators would just step in and crush these agile little startups to protect the big banks, right? But actually, regulation became a powerful enabler for innovation. Over in the European Union, mandates like GDPR came in to standardize complex data protection rules. But PSD2, the revised Payment Services Directive, that was the real structural game changer. It essentially forced traditional banks to stop hoarding all their customers' transaction data behind those closed proprietary doors. And that specific regulatory push is what birthed open banking. By legally mandating that banks have to share customer data securely with authorized third parties, we basically found the ultimate truce. Fintechs can now seamlessly plug into those massive, reliable legacy infrastructures, while the banks get to partner up and essentially white-label that sweet fintech agility. It's a total shift away from pure cutthroat competition and towards a highly strategic hybrid integration. So, as we wrap this explainer up, it's clear that fintech hasn't eliminated financial intermediation at all, it has just fundamentally redefined it. We've moved from this closed, bank-dominated monopoly into a dynamic, hybrid ecosystem driven by massive computing power and serious consumer demand. But as open banking successfully blurs the lines between agile external startups and massive banking vaults, it leaves us with one incredibly critical question to think about. In this seamlessly integrated future, who truly controls your financial data tomorrow?